Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
But we can actually apply the same observations if we're looking to apply a bull call spread. So in this case, we may be looking at option contracts that are a little more expensive than what we're prepared to pay, and we're looking at a way to offset the transaction. Now, there are many benefits to implementing a bull call spread, but sometimes one of the drawbacks is that, of course, you limit your upside potential. So we can use the identification of key support and resistance levels to help establish appropriate strike prices to buy, and then ultimately where we can sell some, in this case, call options off, so that we can leverage that move to the upside and really sell calls that are in all likelihood going to expire anyway. So let's kind of walk through that selection. We're going to first of all apply the same observations that we were applying to the purchase of a call option, in that if we're going to create a bull call spread, we need to have a directional bias to the upside. From there, we're going to also establish the same entry mechanism, which is a break above that resistance level. So in this case, we would still be looking to buy our call options, but now what we want to do is we want to be able to capitalize on a move to the upside, but lower our risk exposure and again, lower our cost basis. Well, we all know that there are a number of choices that we can make when we're selecting our ISE FX options strike prices. In fact, we could do every 50-cent intervals. But the idea is that that's not necessarily, if we bought at 73 and we sold off at 73.5, that's not really going to do a lot for capitalizing on a possible move to the upside. So what we can do is we can go out and we can identify a resistance level, and we can really step back and make the observation that if the pair actually continues to move, a high probability it's going to trade into our resistance level and quite possibly reject or consolidate at that point, which means that any of the option contracts above that resistance level are likely going to expire worthless. So we can sell our call options up and above that resistance level and ultimately be able to capitalize on the difference between the two spreads. So again, I'm just drawing a roadmap for establishing my bull call spread. And if you'll notice, apart from a discussion of what is the most appropriate expiration month, by simply looking at what's happening on this price chart here, I've been able to determine that I want to buy calls and that ultimately I want to create a bull call spread. And I've also established which strike prices I want to utilize for this particular trade. Now, at the end of it all, when we finally go in and we start looking at specific option contracts, we might decide to make a few adjustments based on, being a little bit more strategic with our selection. But for the most part, we can determine what the number one, what an appropriate strategy might be, as well as what strike prices might be appropriate to participate, just by simply looking at this price chart. Now, when it comes to buying put options, again, we're going to look here at the EY and look at some of the more recent trading activity that's taken place with the U.S. and the Euro and how it's influenced the charts here in the EUI. The first thing, of course, is that we can see our moving averages up at that 76 level have essentially crossed over, which means that the uptrend that has been in place is now becoming threatened, and with a crossover, we're likely to see a continuation to the downside. Now, we want to always take into consideration what we would now be looking at is as a support level. And so what you can see here is that in and around that 74.5 zone right in here, we have established a support level. So we would be looking for a break below that support level to establish the purchase of our put options. Now, we can also apply the same outlook for identifying price targets. So in other words, we buy our put options in here as the pair value breaks below that support level at that 74.5, and we go out and we can establish our price targets and our pair value targets down here at 73. based on our observation of these levels here, and you can actually see how the pair actually did consolidate. We did see an extended move below, but for the most part consolidated in and around that 73 and ultimately bounced. So the idea is that once again, when we hit that level, we can make an adjustment to our position, lock in some profits, move our stops, and then by establishing a second target, and I'd have to go back further to identify a third target, but by establishing a second target, once again, we have a roadmap for staying with the trade so that we can continue to profit. Now, at any given time, once this pair value perhaps turns around as it has, and we know today that that the euro actually has in fact gone up a little bit about the euro against the euro, so we're back down trading a little lower. But the idea is that if the trend resumes to the downside, well, we still have a few options in play, and we can take advantage of that continuation down into our second target. And then, if we break below that support level, we can go back in our charts and look at a previous support level and establish a support level for our third target as well. And the same principles apply ultimately to identifying a possible spread, bear put spread opportunity. Once again, we're going to look at that moving average crossover, and again, the 8 and the 21 tend to give us a nice, comfortable way of identifying that change in trend. It's not too erratic as a smaller ratio would be, but at the same time, it hugs the price action nicely, so you get a fairly decent early insight into when that trend is changing. Again, we're going to look at that support level. We're going to identify where it's going to be appropriate to buy those puts, but then we're going to go out and instead of establishing that 72 strike as a 73, 72 as a possible target, what we're ultimately doing is we're going to look at selling off those 72 strikes as a way of bringing in some capital into our account, lowering our cost basis, and then being able to take advantage of that move. Now, of course, we all recognize that the drawback to creating any spread strategy is a limited profit potential. But at the end of the day, if we're really only looking at a move that is likely to be trade between two specific support and resistance levels, then this is a great way to actually lower your cost basis, lower your break-even point, lower your risk exposure, and take advantage of that. Now, again, just a confirmation that you guys can still hear me. I just had a note here that somebody said that they might not be able to hear me, but maybe just a quick type in the chat box that things are working properly. All right, thanks, guys. Great, got that confirmation. So again, we're looking at utilizing the chart strategically to establish a range for where we're going to buy puts and where we're going to sell those puts off. So in these scenarios, what we're looking at is that we're identifying a directional bias using our moving averages. We're going in and identifying key support and resistance levels, and we want to trade with the trend that we believe is in force. So we're going to either buy calls or buy puts, or we're going to create a debit spread, either a bull call spread or a bear put spread, in order to participate. And we're doing all of this by simply identifying some very simple areas on our price charts. Now, when we are talking about option writing, the laws of probability are need to come very much into play, and this is why support and resistance, I believe, becomes a very important factor in deciding what option contracts are appropriate to sell. Now, one of the great things, great characteristics about the FX options market is that ultimately they're cash settled and they're European style exercise, which means if you're the options writer, number one, you never have to worry about taking possession of any underlying security, and number two, you never have to worry about getting assigned early, assignment and automatic assignment does not come until the options actually expire. Now, one important consideration, once again, when we're looking at these types of option contracts, is that the settlement value is actually at noon. So it's the noon rate that is used to settle the value of these particular option contracts. Now, just a question came from Francois about how we decide which options to buy or sell in the money, at the money, out of the money. Again, that actually is a question that I could dedicate an entire hour to. But just to give you a little bit of an idea, if I'm an option buyer, it's typically going to be at the money. If I'm an option writer, it's going to be out of the money, and I'll show you that rationale in this option writing segment. But there are many reasons why we might be one or the other. That has to do with just all of the ways that the different variables affect those three separate categories, which might be a great topic, Steve, as we move forward and consider topics for a later date. But the idea is that as a general rule of thumb, I'm looking to be a buyer at the money, and I'm looking to be a seller out of the money. And it really has to do, as I mentioned, with that idea of probabilities of expiration. So when we're talking about selling put options, for example, one of the very phenomenal strategy for income generating is writing put options. Ultimately, the idea is that you're going to collect a premium, and if you, as long as the pair moves to the upside or stays the same, then those option premiums are going to expire, and you keep the difference. Well, what we're ultimately doing is we want to identify an area where, in this case, the pair just cannot break below. So we can see here, and somebody's suggesting they lost sound. Once again, I'll just take a confirmation that hopefully we're able to, hopefully you guys are able to hear me still. Maybe just, all right, good stuff. Sorry about all these confirmations, but I'm dealing with so many different pieces of technology here. So we're looking at this case. What we can see here is on 3 separate occasions, we saw the AUX slip down and test that 98 level, and each time we saw a subsequent bounce off of that. Now, we have to be cautious that there's not a follow-through to the downside, but what this is telling us is that this level is a key support, and over the last, in this case, we can see November and December, and in fact, January. So basically the last 3 months, the AUX has been holding strong there, which means each time we've seen a bounce. So if I sell put options off somewhere down below that 98 level, there's a very high probability that in a very short period of time I'll be able to buy them back cheaper, because we know put options will depreciate in value as the pairs go, in this case the pair value goes up. Or I can just sit back and really, as long as the pair remains holding support at that 98, any option contracts that I write below that level, they're going to expire worthless. Okay?
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.